Welcome to the Deep Dive. Today we're tackling a major headache in retail accounting, the dreaded end-of-day batch upload. Most point-of-sale systems just lump all your daily sales together into a single total.
Exactly. And when a customer returns a single item, you're forced to hunt through partial receipts or disconnected records just to figure out what happened. But today, we are looking at an item-centric model that completely changes the game.
With Register POS, there is no waiting for end-of-day imports. Every single product, price, tax, and discount is sent to QuickBooks Online as an individual line item in real time.
That means when a product sells, your inventory decreases in both programs at the exact same moment. Plus, if a customer makes a return, you can process a refund for that one specific product without having to rework the rest of the sale.
It's all about gaining the visibility that drives smarter decisions. Let's dive into how Instant Line Item Sync can help you track profitability by item, category, or vendor.
Because, the sheer architectural shift from that old batching method to this instantaneous item-centric synchronization, it's really one of the most significant upgrades a physical retail space can undergo.
It really is. It completely redefines the central nervous system of a business.
Absolutely.
So if you are, say, managing a high-volume retail environment or overseeing the financial controllership, or, if you simply appreciate the complex data architecture that bridges the gap between a physical storefront and a digital ledger, well, our mission today is to completely deconstruct these hidden mechanics for you.
Right, to really pull back the curtain.
Exactly. We've got a stack of internal articles, some really detailed technical blogs, and an explainer video on the table today. And they specifically detail the architecture of Register POS and its direct integration with QuickBooks Online. We want to show you the fundamental transition from that legacy method of batch daily totals into this modern, real-time, item-centric ecosystem.
Because for decades, the industry they operated under this unspoken assumption that a massive disconnect was just an unavoidable cost of doing business.
Like it was just a law of nature or something.
Yeah, exactly. There was an accepted latency, a hard wall between the physical action of a customer handing over a credit card on the floor and the moment the accounting software actually registered that economic event.
Right.
And understanding how modern architectures, specifically direct API integrations between point of sale and platforms like QuickBooks Online, how they shatter that wall is the key. It's the key to understanding how modern retail scales without scaling its own operational friction.
Okay, so let's start by unpacking the gravity of that latency. Because before we can evaluate the merits of an item-centric model, we kind of have to perform a proper autopsy on the legacy batch methodology.
I like that, an autopsy.
Yeah. Because the batch trap, as we often see it referred to in the sources, it's the root cause of an incredible amount of back-office friction. So why was this methodology the gold standard for so long? What is the specific computational flaw that creates this bottleneck?
Well, to grasp the batch trap, you really have to look at the historical constraints of retail technology.
Right.
Go back 20 or 30 years.
Okay, dial-up internet days.
Exactly. Bandwidth was incredibly expensive, and processing power was highly localized. Point-of-sale systems were essentially isolated terminals.
Right, they were just basically glorified cash registers.
Yeah, they didn't have the capacity to maintain a constant open connection to an external server or a cloud-based accounting ledger. So the software was engineered around those specific constraints.
Makes sense. You build for the tools you have.
Right. The system would locally record every complex, multifaceted transaction. The varying SKUs, the fractional quantities, conditional discounts, shifting tax liabilities.
All that messy data.
All of it. And it would just hold them in a localized database throughout the day.
So it was just caching everything locally until the network traffic died down.
Essentially, yes. The system waited until the store locked its doors. Then, it executed an end-of-day protocol, often generating what's historically called a Z report.
Ah, the infamous Z report.
You know it. But instead of sending the rich, granular data of every individual transaction, it executed a computational compression. It took thousands of unique, independent economic events and crushed them down into a monolithic aggregate string of data.
Just smashed it all together.
Exactly. One giant lump sum for daily revenue, one lump sum for daily sales tax collected, one total for credit card settlements. It then took that single compressed file, the batch, and pushed it over to the accounting software.
Which, that sounds efficient if you're only worried about saving dial-up bandwidth in 1998.
Right.
But it's like trying to calculate a baseball player's batting average when all you're given is the team's final aggregate score for the entire season.
Oh, that is a phenomenal analogy.
Right. You know the team won, and you know they scored 800 runs over the year, but you have zero visibility into who hit the doubles, who struck out, and who actually drove the offensive performance.
That's exactly it. The compression destroys the context. And the immediate operational consequence of this data compression is reporting lag.
Because you're always looking at yesterday.
Precisely. When an enterprise operates on a batch system, the operators are effectively running a 24-hour delayed simulation of their own business.
I was reading the articles on reporting lag, and the cascading effects on supply chain velocity are just staggering.
They really are.
If you're a floor manager pulling an inventory report at 2:00 p.m. on a Tuesday, your dashboard isn't reflecting reality. It's reflecting a ghost of your store from Monday night.
Which means you are making critical capital allocation decisions based on an expired reality.
Right.
Like imagine if an unexpected weather event causes a massive run on a specific seasonal SKU, say high-margin winter gloves.
Okay, blizzard hits. Everyone buys gloves.
Right. The batch system's localized database knows those gloves are gone. But the central accounting and inventory ledger remains completely ignorant until midnight.
Oh, wow. So the procurement manager looking at the central ledger.
They miss the 3:00 p.m. cutoff to issue a purchase order to the distributor.
Because the central nervous system of the business is telling the brain that the gloves are still sitting on the shelf. The data payload hasn't arrived.
Exactly. And that latency costs you the subsequent day's sales. You have empty shelves. But the operational blindness on the floor is only half the crisis. Consider the forensic nightmare this creates for the accounting department.
I can only imagine.
When an accountant or a controller receives a batched file, they aren't receiving actionable ledgers. They are receiving a math problem.
Because the monolithic lump has to be manually reverse engineered to satisfy standard accounting principles.
Yes. A single $50,000 daily deposit hits the bank feed in QuickBooks. But that $50,000 isn't just revenue.
Right, there's a lot hiding in there.
It contains, say, $4,000 in various municipal, county, and state sales taxes. Those are liabilities, not assets.
Okay.
It contains $2,000 in promotional discounts, which need to be categorized as a marketing expense or a contra revenue account.
Yeah.
And it contains the cost of goods sold, which needs to be deducted from the inventory asset account.
Wow.
When the POS only feeds a compressed batch, the accountant has to manually cross-reference generalized POS reports with the bank feed just to untangle that lump sum into the correct chart of accounts.
It's forced forensic archaeology every single month. I mean, think about it like this. If I go to the store and the accountant receives a receipt that just says, food, $150.
Right.
It doesn't tell me I bought milk. It doesn't separate the non-taxable produce from the taxable prepared foods. And it certainly doesn't flag that I used a $5 coupon.
Exactly. It's useless.
If I'm trying to manage a strict departmental budget, that compressed number is worse than useless. It's an act of obstruction. That's how traditional POS systems treat accountants. And this is why the architectural pivot to the item-centric solution is so critical.
It really is. The item-centric model approaches the data from a fundamentally different philosophical and architectural standpoint.
How so?
Well, it rejects compression entirely. It is built on the premise that the individual SKU, the single item, is the atomic unit of retail.
The atomic unit. I like that.
And therefore, the data payload sent to the accounting software must preserve the integrity of that atomic unit.
So instead of compiling a Z report, the system is executing an independent data transfer for every single event.
Yes. In an item-centric architecture like Register POS, the specific product, the exact price realized, the distinct tax jurisdiction code applied, the specific customer loyalty discount, utilized every single one of these variables is encapsulated as an individual line item.
Okay, but it's not queuing this up for a midnight batch, right?
No, absolutely not. It utilizes an open API connection to transmit the full, highly detailed JSON payload directly into QuickBooks Online. The absolute millisecond the payment gateway clears the transaction.
Okay, let's unpack this. I want to interject here and push back a little on the reality of this implementation.
Sure, go ahead.
If I'm consulting for a high-traffic retailer, let's say a busy hardware store doing 3,000 transactions a day, with an average basket size of 15 items.
Okay, pretty high volume.
Right. That is 45,000 individual line items being fired into QuickBooks Online every single day. If I pitch this to their veteran accountant, their immediate reaction is going to be horror.
Oh, I've seen that exact reaction.
They are going to look at me and say, you are going to completely bloat my general ledger. I don't want 45,000 micro entries cluttering my QBO file. I want one clean daily journal entry.
Right. The neat, single daily number.
Exactly. Isn't there a legitimate argument that a blizzard of real-time API calls creates massive data clutter? Why is an individual line item better than that neat compressed number?
It's the most common objection you hear from controllers transitioning off legacy systems. The assumption is that volume equals clutter. But what we find in modern database management is that precision actually automates cleanliness.
Wait, precision automates cleanliness?
Yes, because the batch file only looks neat on the surface. A single daily journal entry of $50,000 is an illusion of cleanliness. It's basically sweeping a chaotic mess under the rug.
Oh, I see. It hides the errors.
It completely obscures discrepancies. If your merchant service settlement is off by $14.50 at the end of the week, and all you have are massive daily batch totals, locating that missing $14.50 requires auditing hundreds of localized receipts against the batch. It's a needle in a haystack.
So you're saying the granular data actually streamlines the reconciliation, despite the sheer volume of the entries?
I am saying the granular data eliminates the reconciliation process almost entirely.
Wait, really? Eliminates it?
Yes. When you feed line item data into a robust platform like QuickBooks Online via a properly mapped integration, the software's engine does the sorting instantaneously.
Okay, so it's not a human doing it.
Exactly. You aren't just dumping raw text into a ledger. The API call tells QBO item A was sold. Credit the specific inventory asset account for item A debit, the cost of goods sold account. Credit the specific subliability account for county sales tax.
Credit the revenue account mapped to this specific product category.
Exactly. The heavy lifting of categorization is executed programmatically by the software the moment the transaction occurs, rather than being calculated manually by a human on the 30th of the month.
That fundamentally reframes the argument. The accountant isn't reading 45,000 lines manually. They are letting the software's architecture route 45,000 distinct data packets into perfectly segregated buckets.
You've got it. The ledger might be long, but it is mathematically perfect and completely automated.
So you're trading the aesthetic illusion of a simple, compressed number for the operational reality of total programmatic transparency.
Beautifully stated.
Wow.
And that transparency is what unlocks the more advanced capabilities of the back office, particularly when we transition from revenue tracking to the true lifeblood of physical retail inventory management.
Which brings us to the operational reality on the floor. I mean, inventory isn't just boxes sitting on a steel rack. It is highly illiquid capital. It is cash trapped in a physical form.
That's the perfect way to look at it.
And optimizing the velocity of that capital requires absolute frictionless alignment between the physical reality of the store floor and the digital reality of the balance sheet.
And the technical mechanism that facilitates this alignment is what system architects refer to as the dual decrease.
The dual decrease. Break that down for us.
So because Register POS and QuickBooks Online are bound together via synchronous real-time webhooks, a dual action trigger occurs at the checkout.
Okay.
The moment the cashier scanner registers the barcode and the payment clears, the database command decreases the inventory count for that specific SKU in the localized POS system. And simultaneously, this is the key. It pushes a command to QBO to deduct that exact same unit from the central inventory asset ledger.
I love this part. I always visualize this as having an invisible ghost shopper standing in the back warehouse holding a master clipboard.
A ghost shopper, yes.
Right. The exact split second a customer at the front register buys a power drill, that ghost shopper in the back room strikes a line through that drill on the master inventory sheet. There is zero latency.
That ghost shopper analogy perfectly illustrates the concept of perfect synchronization. When the systems are aligned as transactions occur, the physical store floor and the digital accounting records are always perfectly matched.
They never diverge.
Never. They exist in a state of continuous, perfect parity.
Okay, but I have to play the skeptic again here.
I wouldn't expect anything less.
Because I know the reality of retail IT infrastructure. We are relying on a continuous, uninterrupted stream of cloud communication. What happens when the physical infrastructure fails?
The dropout scenario.
Yeah. If the store's ISP goes down or the local Wi-Fi router drops packets during a massive lunch rush, does the whole synchronous stream collapse? If the API call to QBO times out, do we suddenly have massive data discrepancies between the POS and the ledger?
A fair question, and that is a critical vulnerability in poorly designed cloud architectures. But enterprise-grade item-centric systems anticipate network degradation.
Okay, so there's a failsafe.
Exactly. While the primary protocol is synchronous real-time transmission, the system architecture includes asynchronous queuing and local caching as a failsafe.
Meaning, if the internet drops, the register doesn't just freeze.
Right. If the external network connection drops, the POS doesn't stop functioning, and it doesn't lose the data. It continues to process the line item transactions locally, encrypts the payloads, and queues them in a secure local spool.
It essentially creates a temporary, highly detailed holding pattern.
Correct. And the moment the network handshake with QuickBooks Online is reestablished, the POS chronologically pushes the queued API calls, executing the dual decrease retroactively, but with the original timestamps perfectly preserved.
Wow. So the ledger updates accurately, ensuring that even in the event of an infrastructure failure, the fundamental integrity of the item-centric data isn't compromised by a forced batch compression.
Exactly. That local caching mechanism is vital. It guarantees that the data retains its DNA, even if the transmission is temporarily delayed.
And that unwavering data integrity directly addresses the crippling administrative burden of manual inventory updates. I mean, the frustration of missing inventory adjustments in legacy systems is huge. The disconnect between the floor and the ledger almost always requires human intervention to bridge the gap.
And human intervention at the data entry level is the primary vector for systemic corruption.
100%.
In a disconnected system, a floor worker has to manually update a spreadsheet, which is then passed to an accountant to manually adjust the ledger.
It's a game of telephone.
It is, and it guarantees errors. It leads to the two primary operational failures in physical retail: ghost inventory and blind stockouts.
Let's bypass the basic definitions of those terms because I think anyone managing a supply chain knows the pain of a stockout. But let's look at how the real-time API actually prevents the underlying data condition that causes them.
Well, a stockout isn't just a failure to order. It is a failure of visibility.
Okay, say more about that.
In a batch system, the algorithm calculating your reorder points is perpetually starved of current data.
Because of the 24-hour lag we talked about earlier.
Right. If your reorder threshold for a specific industrial solvent is 10 units and you sell 15 units on a busy Tuesday morning, the batch system's local database knows you were in the negative. But the central purchasing system still thinks you have 25 units until midnight.
So the automated purchase order isn't generated.
It isn't generated, the vendor shipping window closes, and you spend Wednesday and Thursday turning away contractors who need that solvent. You bleed revenue because your ledger was lying to your procurement system.
But with the dual decrease firing via API,
the moment the 16th unit is sold at 10:30 a.m., the central ledger in QBO drops to 9 units.
triggering the reorder point immediately.
Yes. The QBO threshold triggers, an automated alert is sent to the procurement manager, and the purchase order is issued by 11:00 a.m., securing next day delivery.
That's incredible. The real-time data sync transforms the supply chain from a reactive lagging mechanism into a proactive predictive engine. Less paperwork equals more time actually serving customers.
Exactly. And the time saved for staff and accountants is massive.
Because there is no reporting lag, managers don't have to rely on yesterday's reports. Checking sales summaries or inventory levels at any time of day guarantees current information, allowing for confident midday reorder decisions.
Right. It's the difference between navigating a ship by looking at the wake behind you versus using forward-facing radar.
So what does this all mean for the dreaded audit? If everything is perfectly mirrored, does this mean the concept of balancing the books at the end of the month changes completely?
It fundamentally shifts.
Yeah.
The traditional audit is effectively a massive, stress-inducing reconciliation event. You are trying to prove that the revenue recognized matches the inventory depleted over a 30-day period.
Right, and constantly finding localized discrepancies.
Exactly. But when you utilize an item-centric real-time sync, the system is performing micro-reconciliations with every single transaction.
So it's like continuous auditing.
Yes. The books are essentially balancing themselves thousands of times a day. By the time the final day of the month concludes, the controller doesn't have to launch a forensic investigation. The architectural design of the system prevented the discrepancy from occurring in the first place.
Because the cost of goods sold, the tax liabilities, the inventory asset valuations, they're all perfectly current.
Exactly. As the sources point out, this attention to detail leads to consistent books and faster audits. The audit becomes a verification of a pristine system rather than a cleanup of a chaotic one.
We've established how this architecture optimizes the back office, streamlining the controllership and empowering the procurement team. But I want to pivot the lens to the front of the house now.
Okay, the customer experience.
Right, because we've solved the headache for the accountant and the inventory manager in the back room. But how does this granular item-centric data translate to the customer standing at the front counter? Technology that only serves the back office is only doing half its job.
I completely agree. And the manifestation of that data at the customer level is the invoice or the receipt.
Okay.
Accuracy begins with details that the customer can actually see. In legacy systems, because of the localized storage limitations we discussed earlier, receipts were notoriously cryptic. They relied heavily on truncated strings and generalized department codes.
Oh, right. The classic MISC HDWR $24.99 on the line item that leaves you wondering what you actually bought 2 days later.
Exactly. That truncation creates cognitive friction for the consumer. It breeds uncertainty.
It really does. I hate looking at a receipt and not knowing what I paid for.
But a system like Register POS creates detailed invoices that show exact product names, quantities, prices, and taxes. Because it is feeding from and mirroring the comprehensive data fields in QuickBooks Online, it generates a highly legible, fully expanded invoice.
So instead of MISC HWR, it reads, DeWalt 20V Max Lithium-Ion Battery Pack QTY1, $24.99.
Precisely, followed by the exact parsed-out state and local tax liabilities applied to that specific item.
And while that might seem like a minor formatting upgrade, the psychological impact on the consumer is significant. When customers understand exactly what they bought, it builds trust.
Yes. Transparency turns confusion into confidence, and confidence becomes customer loyalty. When a commercial client or a retail consumer can instantly audit their own invoice, it reinforces trust in the merchant's operational competence.
And from a purely operational standpoint, that detailed record significantly reduces disputes and unnecessary follow-up calls.
Huge operational benefit. If a customer's receipt is cryptic, they call the store the next day to dispute a charge,
which triggers a cascading loss of productivity. The customer service rep has to abandon their current task, log into the legacy POS, pull up a generalized transaction hash, and attempt to reverse engineer the cashier's actions from the previous day.
It's an incredibly inefficient use of payroll. With an item-centric system, if a dispute does occur, the representative pulls up an exact mirror of the QBO ledger entry. The data is immutable, perfectly parsed, and instantly legible.
It keeps the staff focused on the next person in line instead of hunting through disconnected records.
Exactly. It turns a 10-minute forensic investigation into a 30-second clarification.
But the ultimate test of any retail architecture isn't how it handles a clean, straightforward transaction. The real stress test is how the database manages a disruption to the continuity of a sale. I am talking about the universal retail nightmare.
The return process.
Yes. The computational nightmare that is the partial return. Returns usually disrupt bookkeeping and cause checkout bottlenecks.
The partial return is where legacy batch systems and traditional relational databases truly show their age. To understand why a return is so difficult, you have to understand how legacy databases lock data.
Okay, here's where it gets really interesting. Let's set up a relatable scenario to map this out. Imagine you're a contractor.
Okay, I'm a contractor.
You come into the store and purchase $2,000 worth of materials for a massive weekend build. You have 40 different SKUs in your cart: lumber, plumbing fixtures, electrical wire, and a single $15 box of 2-inch deck screws.
A very full cart.
Right. And the store is running a promotion. Spend over $1,000, get a 10% blanket discount on the entire basket. So the cashier scans all 40 items. The POS applies a complex, prorated 10% discount across the varying price points of the items, calculates the specific tax liabilities for the different product categories, and you pay the final total.
A highly complex, mathematically intertwined transaction.
Exactly. Now, you drive to the site, unload the truck, and realize you bought 3-inch screws instead of 2-inch. You only need to return that single $15 box.
Dread sets in.
Oh, total dread. You drive back to the store, walk up to the counter, and ask for a refund. Usually, the cashier sighs and physically braces themselves because they know what they're about to have to do to the system.
Because in a legacy architecture, the database links all 40 of those items to a single primary key, the transaction ID.
Right.
The items do not possess independent autonomy within the database once the sale is finalized. They are bound together as a single, immutable block of data.
So the system literally cannot isolate the screws.
It cannot. If the cashier attempts to remove the screws, the legacy system cannot cleanly recalculate the prorated 10% blanket discount, nor can it dynamically unravel the cascading tax liabilities associated with that specific fraction of the total.
Because the database is locked.
Yes. To process the refund, the cashier is often forced to reverse the whole mile-long receipt. They have to void the entire $2,000 40-item master receipt, process a manual refund for the full amount, and then manually re-ring the remaining 39 items to generate a new, clean transaction ID.
Which is an absolute nightmare. It holds up the line for 20 minutes, frustrates the customer, and creates massive, messy void logs that the accountant has to untangle the next morning.
When they see a massive negative journal entry followed by a slightly smaller positive one, yes.
Now let's look at the Register POS solution. Because every product is tracked as a separate line item, a cashier can process a refund or an exchange for that one single item out of the massive purchase,
without having to rework, void, or touch the rest of the original transaction.
But when the system handles just that one item, how does it handle the complex math of the return? Like if there was a specific tax or a bulk discount applied just to those screws?
Well, because the system was designed from the ground up to treat the individual SKU as the atomic unit, the transaction ID isn't a monolith. It is simply a digital envelope containing 40 independent, fully realized microtransactions.
Oh, so the items maintain their autonomy.
They maintain complete data autonomy.
Yeah.
When the original $2,000 sale was processed, the system didn't just calculate a 10% discount on the total. It computationally fractionalized that discount.
It respected every individual component.
Exactly. It tagged the $15 box of screws with its own specific metadata. Original price, $15. Applied prorated discount. $1.50 revenue, $13.50. Associated state tax at 7%, 94 cents. Associated county tax at 1.5%, 90 cents.
It embedded the exact DNA of the complex math into the line item itself.
Right. The line item carries its own specific ledger instructions. So when you walk back into the store to return just the screws, the cashier scans the barcode. The Register POS system isolates that single line item.
It knows exactly how to reverse that specific microtransaction cleanly.
Yes. It doesn't need to unlock or disrupt the other 39 items because the screws already contain the precise mathematical roadmap for their own reversal.
It just runs the microtransaction in reverse.
It executes a targeted, isolated reversal. The system instantly processes a refund for the exact $13.50 in revenue, and it accurately reverses the exact 24 cents in state tax liability and $2.20 in county tax liability.
And the lumber and the plumbing fixtures remain completely untouched in the database.
Untouched. And because of the real-time API integration we discussed earlier, the moment the cashier finalizes that partial return, QuickBooks Online updates automatically to reflect the returned inventory and refunded cash.
The dual action trigger fires again, but this time in reverse.
Exactly. QBO automatically debits the sales returns and allowances account, debits the specific sales tax payable accounts, credits the cash or merchant clearing account, and simultaneously increases the inventory asset account by 1 unit of screws while crediting the cost of goods sold.
The accounting complexity is completely abstracted away from the cashier. They just scanned a box of screws and clicked refund.
And the item-centric architecture executed a flawless multi-step database query and a ledger adjustment in the background. It entirely removes the friction from what used to be the most volatile touch point in retail customer service.
It really is the aha return moment. It replaces operational anxiety with computational grace.
Very well put. And once you have established a system that can handle data with this level of granular precision, both in forwarding sales and reversing returns, you have built a foundation that goes far beyond basic bookkeeping.
Right. Which brings us to the final segment of our deep dive. We've seen how line item data fixes the past with returns and manages the present with inventory sync. Finally, we need to look at how this data acts as a foundation to predict and control the future of the business.
Transitioning into predictive analytics and granular reporting.
Exactly. Because up until now, we've been talking about defensive posturing, preventing stockouts, avoiding audit discrepancies, eliminating return bottlenecks. But the item-centric model is ultimately an offensive weapon for strategic growth.
It transforms basic sales reports into powerful business insight tools.
Let's break down how line item data fed directly into a robust engine like QuickBooks Online creates actionable intelligence. How does it reveal true profitability?
Well, in a traditional batched environment, your reporting is macro level. You know your top-line revenue, you know your aggregate cost of goods sold, and therefore you know your gross margin for the entire store. We operated at a 32% margin this month. But that macro number is an amalgamation. It hides the underlying realities. It hides the fact that one department might be operating at a 50% margin, subsidizing another department that is quietly bleeding cash at a 10% margin.
It's the batting average analogy again. It's the difference between just knowing your team won the game versus having the exact stats on which specific player scored which points to get you that win.
Exactly. With Register POS mapping line item data directly to QDO's architecture, you achieve micro-level visibility. As the sources mention, retailers can track profitability down to the specific item, the category, or the vendor.
So I can look at a dashboard and see that while the high-end power washers are generating massive top-line revenue because they sell for $800, their actual profit margin is incredibly thin due to wholesale costs and high shipping freight.
Right.
Meanwhile, the $12 specialized nozzle attachments, which I barely notice selling, have an 80% profit margin and are quietly driving the actual net profitability of the entire department.
Yes. That exact realization is what we call finding the honest view of the business. Clean data at the item level creates an honest view of day-by-day performance. High sales volume is a vanity metric. High margin contribution is a vitality metric.
Granular data strips away the vanity.
It does. It replaces guesswork with strategy. And once managers have that honest view, they can use this granular data to plan promotions effectively, manage precise reorder quantities, and adjust pricing with absolute confidence.
Because you don't have to guess how deep you can discount an item.
Exactly. You can analyze the exact profit threshold of a SKU and design a targeted promotion that maximizes volume without crossing into negative margin territory.
Or identify slow-moving inventory that is tying up capital on the shelves.
And execute highly precise markdowns to liquidate it, knowing exactly how that markdown impacts your daily P&L in real time.
But I want to introduce a dose of reality here, especially for the broader spectrum of business operators listening.
Okay, lay it on me.
If I run an enterprise-level operation with massive square footage, tracking SKU-level margin makes total sense. But what if I'm a small retailer? A specialized local operator like a boutique pet supply store or an independent bicycle shop?
Right.
The architectural documentation heavily emphasizes the ability to track profitability by vendor. Tracking profitability by vendor sounds like a corporate-level metric. Why should a local shop care about vendor-level line item tracking?
It sounds like a massive corporate metric, but it is arguably more critical for the independent retailer than it is for the big box store.
Why is that?
Because the independent retailer has a finite, highly restricted asset shelf space. Every square inch of a boutique pet store must be optimized for maximum yield.
Ah, revenue per square foot.
Exactly. And vendor-level profitability tracking is the ultimate tool for optimizing that yield. Let's say your pet store carries 2 premium lines of organic dog food. Vendor is a legacy brand. They've been around forever. They have great brand recognition, and their product moves steadily. Vendor B is a newer boutique distributor.
In a batch system, the owner just sees that premium dog food as a category is selling well.
Right. But with item-centric tracking mapped to vendor profiles in QBO, the owner can run a comparative margin analysis. They might discover that while vendor A sells slightly more volume, their wholesale pricing is rigid, their shipping costs are higher, and the resulting profit margin is 22%. Meanwhile, vendor B's product, while selling slightly fewer units, has a significantly lower wholesale cost and a highly optimized supply chain, yielding a 38% profit margin.
That is a massive discrepancy hiding underneath a seemingly successful category.
It's a game-changing revelation. Knowing which vendor supplies the most profitable, fast-moving items empowers even the smallest retailer. Armed with that specific mathematical proof, the small business owner gains immense leverage.
They can physically restructure the store, allocating shelf space effectively by moving vendor B's highly profitable products to the prime end cap displays.
Exactly, to accelerate their velocity. And they can use that data to negotiate better. The owner can sit down with the sales rep from vendor A, pull up the QBO vendor profitability report and say, I have the hard data showing your line is underperforming on margin compared to my other suppliers. If you want to keep your current shelf allocation, we need to renegotiate our wholesale tier.
Wow. That level of negotiation is usually reserved for massive corporate buyers.
But the technology democratizes that leverage. The synchronization between the point of sale and the accounting software gives the independent operator the exact same analytical firepower as a multinational chain. It protects their margins.
It essentially allows the small business to punch significantly above its weight class. You aren't just trusting your gut on what's selling, you are weaponizing your own data to protect your margins and optimize your capital allocation.
Ultimately, that is the true value proposition of the entire architectural shift. Summarizing it all, the item-centric structure brings a rigorous mathematical discipline to the very core of the operation. It creates a foundation for growth because the data is clean, reliable, and instantly available.
Because the data is pristine, it is granular, and crucially, it is instantaneous. You are no longer fighting the latency of your systems. Your systems are constantly illuminating the optimal path forward.
It is a total paradigm shift in how we manage physical commerce.
It really is incredible how much friction evaporates when you simply start compressing the data and let the individual items speak for themselves.
Well said.
To recap the journey of this deep dive for you, the listener, we moved from the murky waters of batched end-of-day totals into the clear, real-time synchronization of the item-centric model,
Leaving behind that 24-hour latency and the manual untangling of massive data dumps.
We saw how instantly aligning register POS with QuickBooks Online through the dual decrease mechanism eliminates manual entry and cures ghost inventory.
And we broke down how it returns into a frictionless breeze, embedding the DNA of discounts into single-line items.
Finally, we explored how providing that granular reporting is necessary to actually grow a business, empowering you to optimize shelf space and negotiate vendor terms. It's a comprehensive masterclass in upgrading the invisible architecture of your business.
It really is.
If you want to see this in action, you can learn more at abilityregister.com. You can email Mike at sales@abilityregister.com or call 9-Register-8 today to see how Register POS can be the perfect fit for your store.
But before we sign off, I want to leave you with one final provocative thought to ponder.
Okay, let's hear it.
We've spent this entire deep dive focused on optimizing the physical storefront, the brick-and-mortar reality. But if our systems can now seamlessly mirror physical reality into digital accounting, in the exact fraction of a second a transaction occurs.
Down to a single discounted screw.
Right, down to the microtransaction. What does that actually mean for the future of the physical storefront? As data lag reaches absolute zero, the operational difference completely vanishes. The line between running an e-commerce business and a brick-and-mortar business might just completely disappear.
Because you are managing physical goods with the exact same instantaneous digital precision as a purely online retailer, that is a fascinating thread to pull. We aren't just taking pain relievers to manage the symptoms of the messy end-of-day batch upload anymore. We have fundamentally rewired the central nervous system.
Exactly.
Well, thank you for joining us on this deep dive. Keep asking the big questions about the invisible systems that run our world. We'll catch you next time.